Hey, can you guys hear me? Yes, I can hear myself. How are you? Is Beanie here? I'm the one to speak later, this one, but I also do my own opening. so I have a script here, but I'm not going to follow this script. My usual script to open is, have you had your dinner yet? Poor thing. I also haven't. Not to worry. All right, so today, my name is Beanie. I'm SGX Academy trainer. I'll be doing this topic here and to talk about why this moment you want to look into the Chinese, especially the Hong Kong stock market. So that's number one. Later on, about 15 minutes later, Jamie, head of Warrants Singapore and Macquarie Group, she will be sharing with you based on what I've talked about, then how you could tap into the opportunities. Okay, basically with the use of warrants. Then I will come in again. You see 3 chairs here, right? So we'll be doing a fireside chat with Bruce and Tim. So Bruce is the head of fixed income at CSWAP Asset Management. And Tim is the head of product and investment advisory at SGX International. And I'll moderate the session. So you see the left side and the right side, my right, and your right side, the other side, right? There's this pigeonhole. That's where you can ask questions. I will help you ask first because there's a lot of questions I'm interested. Basically, should we get inside the Chinese market right now? Because when I was talking about the Chinese market, especially Hong Kong market, right? The students will always ask me, Beanie, when will the Hong Kong Hang Seng get out of ICU? So every time, whenever it goes up a little bit, then you will move down more, and it will enter the ICU. So always the question would be I have for Tim and Bruce is that whether it has gotten out of ICU or not. All right. So if you do have questions later on, based on what I've discussed, based on what Jamie talked about, and as well as the fireside chat, do let us know via the pigeonhole. Then I would be looking at the questions and I would ask that to Tim and Bruce. And that's it. Let's get started. How many of you have attended my seminars and webinars before? Oh, yes. Thank you. Seen me in person? Today, I'm wearing this, especially with this denim jacket, especially put on. The reason being was that later I will introduce my YouTube channel, and a lot of viewers ask me why Beanie always wear the same jacket every time. That's my lucky jacket. That means that every time I wore it and I talk about it, then it will be quite accurate. That's why today I wear this today. Okay? All right. Hope that it brings you good luck. Now, topic for today would be an insight into China's economic trajectory via technical analysis. So quickly, disclaimer, whatever that I'm covering here would be for educational, no financial advice. And then this is Pigeonhole, the QR code. The passcode for today is 19 June 24. Easy remember because that's the date today, 19 June 24, all right? And I'll be doing 2 things, especially on what I'm specialized in, which is to look at the price. A lot of people say, hey, Beanie, why do I need to look at prices? Why do I need to look at charts? Okay, we can have the fundamental views, but most important, whatever that appears as prices on the chart represent action from the market, meaning that these will be common tools for others, whether they are fund managers or huge investors, to talk to us, to tell us what they are doing and to leave trails in the market. So that's the reason why today I want to look at 2 things. 1 would be Hang Seng Index, 2 would be HS Tech, which is Hang Seng Tech, and also some stocks, but to give you the knowledge, okay, to fish, not only to cover this, but to show you what I'm looking at, why I'm using this, and why you can also use that as a reference. Okay, so you can use it for other analysis as well. Okay, so this is me. It's better to look at in person. Do I look the same or different? Oh my gosh, how different? Always they will say in person, you look younger. Correct or wrong? I can't sleep tonight. Okay, so I'm SGX Academy trainer. Myself dabble into many things. Forex, commodity. If you ask me, I'll go. I can talk about it on oil, on FX, on stocks, on indexes. You know, like for example, today Hang Seng moved up about average 3%. Hashtag moved up about 3.6. So I talked about this like last week already in my YouTube channel. And if you know that in a lot of the sessions I did, basically the start of this year, I've been talking about the Hong Kong market and some of the stocks. Okay, so you do see me a lot in the newspaper, but today you see me in person. It's okay, it's good. Tomorrow I'll be in the newspaper again, so you can look at the newspaper tomorrow, Friday also. Okay. Okay, so the first thing that I want to bring to attention is that somewhere in April, all right, China releases the Q1, and the GDP grew 5.3%, and the thing is that it exceeded expectation. So we start to see two things, okay? We start to see that the Hong Kong market gather a little bit about momentum. Okay, in April, if you look at to the right side, okay, the Hong Kong, basically the Hang Seng, moved up. Okay, so from start of this year, which is about Feb, until now, right, the Hang Seng moved up about, from the low point, about 35%. But in comparison to the left side, which is S&P 500, it's a very, very stark comparison because the US market has only one direction, which is up, right? And the Hong Kong market has only one direction, which is down. Okay, so if you are investors, you want to be looking at buying up because up means higher and higher, but you are also scared, isn't it? Okay, so then today will be a perfect chance that we can see whether there will be some opportunities. Again, whatever that I'm going to cover will not be financial advice. I just present to you the facts as of what I'm seeing from the chart. The experts later on would be via the fire chat. You can ask them what they think. Okay, so the right-hand side would be Hang Seng. But do you know that if I look at the 20-year price movement, Hang Seng coming down might not be a bad thing because if you look at the past 20 years, the data here since 2000 all the way until now, right? Hang Seng been traveling along this blue line. We call this a trend line. If you connect all the low points here, happened to be that coming near to that low point that happens around 2024 early. So in this case here, it might be that we might have an opportunity, not a suggestion that you should be going in, but to present to the fact that you are not looking at a buy near the top, but if you are looking at somewhere around here, it means that the Hang Seng has already corrected about 55% from the high. So that's represent a half point, which is basically half price. Okay, so that's based on 20 years of data from the price action. Did I skip here? Okay, here we go. All right, so what I presented here is the chart of Hang Seng, all right, in the near term. So that's about 2022 all the way until now. Two things to bring to your attention, which is the color of this moving average. So what does moving average from the technical point of view tells us? It gave us an implication on the trend. Anything that's red in color basically say that the trend is down. When it flip, okay, you see that flipping point, that means the color change from red, right, to green, it means that the trend is up. While moving averages, they are essentially slow, lagging, but they give a very good representation of the trend. Okay, so what happened in the past since 2023 to 2024 was that we saw what color moving averages? Here, this one. Red or green? Red, right? So that essentially means that during that period, the trend was down. Okay, now right now, around the start, around April, this time here, what is the color that you're seeing right now? This one. Green, right? So that means that somehow the moving averages have flipped. It flipped from a bearish movement to, as what we are seeing, a temporary bullish movement. Okay, so that's what the technical is telling us. Okay, that means that a change in color that essentially represent a little bit on the bullish movement right now for the moving averages. Okay, they have flipped already. Now, what caused the flip? There can be a few things. One, fundamental. We saw that starting from the start of this year, China had quite a good performance in terms of GDP. People get a little bit more enthusiastic. It could be also because that the selling has sort of like slowed down. Okay, why do I make this statement here? Because from technical point of view, I've seen an inverted head and shoulder here. So this one looks like a left shoulder, the right shoulder, sorry, the head, right, and the right shoulder. How do you look at this as inverted head and shoulder? You have to flip yourself the other side and look at it. Okay, so that's basically like a reversal pattern. So in other words, right, from the technical point of view, it seems that somewhere in April, all right, the Hang Seng has flipped. And I did the YouTube video here. Okay, you can see this denim jacket, the lucky jacket. Yeah, I'm wearing it now. Okay, but I make a remark around 17,300 that the Hang Seng index has finally reversed. So bottom line is that you have to take out your phone, take a photograph, and scan this QR code to subscribe to my YouTube channel, because I do cover quite a lot of Singapore and Hong Kong stocks as well as indexes. All right, and they are quite well timely, because yes, 2 days ago I just released a video on Tencent, and today Tencent moved up about 3+%. Okay, all right. So from the technical point of view, I think that Hang Seng has short-term reversed. Okay, with some key levels that you might want to take note of. All right, 20,000, which is a round number, being its barrier. That means there is resistance. Okay, meaning that price does move up and moves out. So I'm expecting that this wave might move to 20,000. Followed by this one here, which is 22,500. And it's not hard to imagine this, because in the previous round, around 2022, we saw that Hang Seng bounce up by 55% from the low. Okay, right now it's doing about 35%, which means that from a logical deduction, there might be still a 20 to 25% movement based on what happened in the past. All right. Okay, so next, right, we take a look at Hang Seng Tech. So Hang Seng Tech has mainly the tech stocks. And you realize that, well, the US tech stock moved up, the Hong Kong, some of the tech stocks are slowly creeping up. I'm not sure whether you note Lenovo, which is your computer. Today it went up 9%, and Lenovo was also one stock I covered in my YouTube when it was right at the low. Okay, because not only that they are making computers, they are doing a lot of AI with their server. That means they are following what NVIDIA is doing right now. Okay, on a smaller, lesser scale. Okay, so if you take a look at Hang Seng Tech, same thing. The moving averages have flipped. Right now, the moving averages is acting as a support. When I did the slide, I thought that 3,700 was a very good support level, and in fact, that today price moves up to 3,008 plus. That means just a 2 days difference, 3 days difference. It moved up by 100 plus points already. Okay, so if you are looking at what happened to Hang Seng Tech, it's what we call as a consolidation basing pattern. It probably hasn't started trending yet, but should it break out? Breakout means that should it move higher, we might be able to see some massive movement here. Of course, that the resistance have to be broken, which is what I've highlighted here, and as well as that, just to take note here, the long term is still downtrend, but short term we are starting to see some opportunity here. So later on, Jamie will be talking about warrants, which is best for short term trading, and that gives you some insight into how you can use warrants to tap into all these price levels. Okay, so Short term, we are starting to see that inch up, but long term, it is still down for both Hang Seng and HS Tech. But based on the short-term moving averages, both indexes have flipped. Likewise, if you look at the individual stocks, from my opinion, from the technical point of view, what we should be focusing on would be to look for stocks, right, that equally have shown a flip in the moving averages. Because these are stocks that are stronger in its fundamental, stronger in strength. That's why you start to see also that they have. Okay, so here, I've just give you an example of 3 stocks that have flipped, but you can just go back and put in the same moving averages. I use 21 and 55 to show the flip, right? Equally, you can see that. The first one is Tencent. Okay, just to also talk about Tencent, you find that Tencent previously, the moving averages were moving down, red color. Then somewhere 2022, it turns into green. Then it starts to become, what color? Red again, right? And right now, what is the color of Tencent? Red or green? Green, right? So that's a flip. And that's because Tencent moved up, the so-called the moving averages show trend, right? The short-term trend has also started to move up. So today, Tencent moved up by about 3+%, and it stays supported here, and from here it moves up. And by the way, I also did a YouTube video at here when Tencent was 304. Yeah, I did a YouTube here. I say a powerful breakout, again the denim jacket, and Tencent 304, and from there it moves all the way up to about $400. All right, have you taken a photo and follow me in YouTube? This one don't need any money, right? Okay, it's updated. That's the latest technology. I did quite a lot of YouTube, and sometimes when I walk, right, they say in my shorts, by the way, and I like to cycle, so in my shorts and bicycle, right? Hey, Bini! So I better make sure that I cut my hair today. Okay, so this is what I'm trying to say, that it has flipped. Okay, then same thing for Xiaomi. I did a video here at the bottom here, before it moves up. And today Xiaomi moved up by about 6% or 6%, yes, yeah. So same thing, that's the key level that I've talked about. It's about 16 plus to 17. Today move up from 17, so 2025, and same thing, right? I talk about that one pattern to watch out for if you're looking for reversal, and that's around here, the start of 2024. And Xiaomi, before it launched the EV, which is this SU7 EV, okay? And lastly, one last one, which is Hong Kong Exchange. It's not a tech stock, but we are seeing quite a nice volume in Hong Kong Exchange before it bursts up. I think that's enthusiasm coming in from the ETF launched, combined launch in Saudi Arabia. All right, so that could bring in some inflow, but Hong Kong Exchange might see some reversal if we start to see the Hong Kong market moving up. Especially right now, they said that even in typhoon, they will continue trading, no more shut already. So I guess that they're doing a lot more efforts to really boost up. So yes, we do see a flip in the moving averages with key levels that I've noted here. Today, Hong Kong Exchange moved up about 2+%. All right, so the resistance would be about $300. And one thing I bring up the volume was because as it starts to move down, the volume isn't rising. That means as it moved up, the volume was rising, represent quite a strong interest. But as it starts to move down, the volume was actually declining, represent that actually the selling interest wasn't really that strong. Okay, so if you take a look at the 3 stocks and indexes that I've covered, there's only one key theme here or takeaway would be the moving averages short term have flipped. And if you're looking at your own trading, all right, then you can also use this method to spot for potential stocks. All right, I come to the end of my presentation. I will now invite Jamie from Macquarie, head of the warrants of Macquarie, to come up to the stage to talk about strategies and insights into structured warrants. And I see you guys later on. Don't leave, stay here. Thank you.
Thanks, Bini. I actually didn't notice that, that the denim jacket is the lucky factor to, you know, her getting her view right, because I would like to propose, BD, could it be every time you wear your denim jacket and you're speaking with me, your views tend to be right? And why do I say this? I recognize some of you from the last seminar that we had at the Macquarie office in March. Back then, Bini had already called a very bullish, she already had a very bullish call on the Hang Seng Tech. And what happened in less than a month later was we saw the Hang Seng Tech, the Hang Seng really is moving, you know, close to 40%, right? So, you know, and then we've got CGS outside. I think the last time again we did a seminar together, Vinny, and when you're wearing a denim jacket, you had a very bullish call on Nikkei. And indeed, the Nikkei then became the best performing index, you know, pretty much, you know, for the year, and looks to continue this year. And we did that sometime in November 2023. And, you know, the Nikkei has moved from when you called it at 33,000 to close to 40,000 in really a very short period of time. So all I can say is, you know, all of you here today, for signing up and for showing up, you know, I do hope you get handsomely rewarded, prettily rewarded. And one of the tools that can hopefully help you get very rewarded in the market is via this instrument called warrants. Now, before I go on further, can I just check, how many of you are already invested in China? From this year or from years ago? Because I would say I'm one of you. I've been invested since 2021. And you imagine my portfolio now looks terrible. It got worse and worse as I averaged down, you know, because it went from basically Hang Seng 27,000 to basically 10,000 lower, right, where we are now. Now, if you are like me, you know, vested in China, already caught long in China, you know, after all these years, you're probably relieved when someone like Bini and other experts tell you that, hey, the bullish trend looks like it's coming, right? But yet I'm 10,000 away from where I first went in. So I'm a little bit scared because I've been averaging in, I'm still wrong. My portfolio is down 25%, 30%. What can I do? Now, potentially, if you are like me, I'm telling you about a tool known as warrants where you can get invested at really only a very small capital outlay and potentially make gains that will more than cover the portfolio losses that you're sitting on from having gone long China from years back. Now, warrants are essentially two types, okay? It's a call and a put. Now, a call moves alongside the underlying, going up when the underlying goes higher. The put, on the other hand, is one of probably the most underutilized instruments in the market, but that's changed since May of this year, as we can note via warrants, where we saw a lot of people piling in on Hang Seng put warrants and doing quite well in the short term from May till now. But essentially, they move higher when the underlying goes down. So a lot of people don't know about it because a lot of Singaporeans like to only what? Go long. Right? We only like to chase bullish trends and we don't know what to do. We're caught when the market comes off or has a very sharp pullback. Now, please know about put warrants because they are so useful in the short term for you to hedge your long portfolios or even mainly just to profit when the market goes down. Okay? Warrants are listed on the SGX. They are SIP product and they have they're identified by their names here. Looks really long, potentially a bit scary, but actually it's really simple. It starts with underlying that it tracks. In this case, it's HSI, the Hang Seng. In this case, it's what stock? Anyone familiar with this stock? BYD, okay, one of the key stocks on the Hang Seng Tech especially. Now, for the index warrants like Hang Seng, is followed by the strike. So in this case, it's a 19,400, okay? For stock warrants, you don't typically see the strike. It's not reflected in the stock warrant name. Okay, this is followed by MB consistently, standing for Macquarie Bank. We are the only warrant issue in Singapore, so don't have to get stressed out about whether you're buying a Macquarie Bank warrant or not. That's followed by 3 letters which are very important, of which you'll notice the difference here. What's the difference? The one at the top and the bottom. The one at the top is E what? C, standing for which kind of warrant? Call. And then the second one here is a P, standing for the put warrant that I think everyone needs to know about. And then that's followed by 6 digits here, which implies the expiry date in the year, month, date format. Now, expiry dates are also important because warrants are not like shares. You can't hold on to them forever. Okay, they are short-term instruments which you need to exit from well before the expiry date. Okay, but of course, if I'm here to tell you about a product where you have to go in and key into your trading systems, this full name, nobody will trade warrants, right? So essentially, we thankfully have got a short form known as a 4-digit alphanumeric code, and these are unique codes for each warrant. So all you have to do is type in the code here, in this case IAIW, if you're interested in this warrant, onto your trading systems, whether it's CGS or other brokerages. Okay, you need only to key this in and then trade away like you trade shares. Now, I just want to quickly show you, because I think this is probably more convincing than any other thing I can do and any other thing I can say. I want to show you how warrants work. And these are all real-life examples. What I've done is I basically use the price performance of the Hang Seng and the Hang Seng Tech across a month, okay, from April to May. And to show you how warrants work, I want to really show you across various warrants that we've got that existed during that time in the 1 month period that were traded on tight spreads. Their percentage gains and losses versus the warrant, versus the underlying percentage gain. In this case, for Hang Seng, you can see that it's up 21% over this period. So well done for those of you, who got in. But the warrants here in this case, costing anything between 1.8 cents to about 7 cents, okay, close to 8 cents, you would have been able to generate anything between 330% to 670%. It's no exaggeration because these are actual percentage gains. And this is why I say this is a tool that allows you to get in at a very low capital outlay. So you've been burnt, you're scared, but the experts are telling you the bullish trend is coming. What can you do? Use just a little bit of money, a fraction of what you have previously invested into China, and potentially buy a call or put warrant, depending on your view, to get in and earn this kind of returns based on what the market has done, obviously in your favor in this case. But what if you're wrong? What if you had bought a put warrant in this instance? When the market was rallying, you thought, oh, it's at 16,200 already. It's probably going to 15,000 again. What would happen if you had bought the put? In this case, you would have lost also a magnified, and a magnified amount because the warrants move more than the underlying. But in this case, the maximum loss with warrants is 100%, which is whatever you place up front, which is again a low capital outlay and a percentage of the underlying. So the maximum you can lose is whatever little amount you have placed up front, which is 100%. But the maximum you can gain, well, in this case, the sky's the limit, right? This has gone up 670%. And then for Hang Seng Tech, you will see that it's similar. Okay, it has gone up between 250% and 400% when Hang Seng Tech rallied about 26%. Again, this happened less than a month after Beanie and I were conducting a seminar for another broker and Macquarie's offices. So well done you for coming down, and hope we hit jackpot again in this case. Now, what about for shares? I picked out some Chinese shares because obviously they were part of the rally. I picked out mainly the top performers on the Hang Seng index during this period, which are namely Sunny Optical, Tencent, and BYD. Now, Tencent was one of the shares that Beanie talked about. How did it perform during this period? It went up by 25%, which is more than the Hang Seng index. Okay, it went up from 300 honky dollars. 300 honky dollars is how many Sing dollars? Anyone? Any mathematical expert here? Mental sums. Close to 50. Is that cheap? In terms of absolute investment amount? Probably not, right? It will require you, for each lot you trade, it will require you at least how much? For 100 shares. Convert it back to Sing dollars. It will require at least 5,000. And I mean, if you wanted to get in on more, 1,000 shares and all that, it would be 50,000. It's not a lot, okay? But in this case, if you had used the warrant, you could have gotten in at 3.4 cents if you're bullish via a call warrant, and managed to get out at 135% during this period. Okay, that's about close to 4 times. In this case, 5 times the underlying shares. So ladies and gentlemen, this is how warrants work. They require just a low amount of capital outlay, whilst they're able to magnify your returns by various amounts. You can see here there are different leverage or gearing factors, okay? They all grow by different amounts. Anything between, 3 times to, in this case, 30 times, it's up to you to choose. But again, of course, if you get it wrong, the maximum loss that you can make is limited to the small amount of capital you place up front. So if you're scared, yes, it magnifies your gains and losses, but it's only a small amount of capital you place up front compared to the investment that you place directly in the shares. Okay, now I want to talk about put warrants because, like I said, I think people don't use it enough. But in the month of May, as the market rallied so much within a short period of time, some cynical investors, especially the technical ones who look at charts and do technical analysis, actually came in and bought quite a lot of put warrants, and they did well. And this is just a small, example of how some people decided to short the Hang Seng during this period when it looked like it had trouble staying above 18,000. In fact, Beanie did a video for us on Hang Seng, and she had said back then, and this was 3 weeks ago, that chart-wise, it didn't look like she was sure that it was a reversal yet. So if it failed to break, a level around 18,400, then she potentially saw it coming down to around 17,700. And so for some people, they took it quite seriously and they thought, oh, this was not going to stay above 18,000. They came in and they shorted this via a put warrant. In this case, they would have bought some put warrants around between 5 cents to about 7 cents and managed to make gains of between 4.5% to 11% to hedge either their long portfolios or simply just to make a quick profit. And I think a lot of experts will tell you this. Even when stocks are on a sustained trend, the pullbacks can be very fearsome, right? Which is why it's never easy to catch a bullish trend, isn't it? So for those of you who are fearful, now I'm telling you about product. Do something. Do something at times where you are fearing a pullback, because of negative news, whether from China or geopolitics, even though the trend is going up in the long term. Or just simply you're not sure if it's a reversal. Use the put warrants to hedge the very short term. Okay? Now, how do you select a warrant to trade? Essentially, 4 factors. Mainly, number 1, have a view on the underlying. And today, that's what we're here for. A view on the underlying, whether it's the index or specific stocks. Use those levels to decide when you're getting in and out of the warrant. That's followed by setting a holding period, which is important because warrants are short-dated instruments. Okay, you're not meant to hold on to it forever. If you want to hold on to something, buy the shares directly or go consider an ETF, which they will cover on later. But if you wanted to get in and out only in the short term because you're not sure about the longer trend, then via warrants, you have to set the period as well. Okay? And how do you set it? I'll show you in a quick bit to know the maximum holding period. Number 3, decide on the gearing factors because as I've shown you, everyone is happy when their warrant grows 300%, 200%. But are you ready to lose 100%? Are you ready to see a magnified drop in your warrant? Okay, if you're probably happy with just 3 times more than the underlying, 5 times more than underlying, then buy something with a gearing of 5 times. Don't go and buy something with a gearing of 20 times, okay? And finally, always trade any financial instrument on tight spreads, okay? Now, I'll show you very quickly this warrant selector tool that we have. And I've only got a screenshot here, but actually, if you were to go into the warrants website, this is the warrant selector tool. Is there any underlying that you're keen to look at? Anyone? We can quickly choose a warrant based on that. How about Tencent, since it was covered by Beanie? Tencent's okay with you? Okay, so to use the warrant selector tool to select a warrant, you go to warrants.com.sg. Okay, the homepage looks like this. Okay, and to find the selector tool, you simply need to go warrant tools, choose selector, okay, and choose your underlying. Let's look at Tencent. All right, which finished around $390 today. Now, if you were still bullish, what was the level that Beanie said to be cautious of? Do you remember the short-term resistance? Nobody took a picture. I saw some cameras just now, Share with those who didn't pay attention. What was the short-term resistance level? The red line she said to be cautious of. 410, okay? Let's assume that we are ready to go bullish on Tencent until 410, okay? Or maybe we want to be a bit conservative, right? We could do 405. You type in the level, the resistance level you're looking at. Because like I said, warrants are for you to trade the short term where you're not sure whether it will go, if it's a sustained trend and you're cautious of resistance levels or support levels. In this case, we're cautious of a resistance level because we're bullish, right? So we type in 405. Now that's 4% higher from here. And as we know, those of you, if you don't know about Chinese shares, 4% happens in a day. You don't need to wait for a year for it to happen, okay? It can simply happen in a day. Now, what is the maximum holding period for these 2 warrants that you see that we have over Tencent? What's the maximum holding period based on your view on Tencent? To do that, Step 2, to set your holding level, right? The maximum holding level, we only need to increase this by the number of weeks. And you can see from the screen here, basically, if Tencent took 1 week to gain 4%, these two warrants will immediately move anything between 22% to 27%. So about 5 to 6 times of the underlying. But if it took 2 weeks for Tencent to move 4%, now the gains are lesser now. Can you guys see it at the back? Is it too small? Okay. So it will now move up only 21% and 20%. Why is that? Those of you who are familiar who have been to my seminar, why is that? Why is the percentage gain lower with time? Time decay, because of the holding cost. Now, everything comes at a price. It's fantastic if you know your instrument grows by a huge amount at a small capital outlay, right? Maximum loss, small capital outlay, 100%, whilst allow you to enjoy 600% gains, right? So what's the catch? With every instrument, always ask what's the catch. The catch is the holding cost, okay? In the case of a product like warrants, it is very similar to all other listed leverage products, whereby the longer you hold onto the instrument, the more you have to pay. Okay, that applies across products. It's just probably not called time decay. It's called something else. Okay, so go find out. But in the case of warrants, it's called time decay, whereby with time, the warrant value decays. Okay, but even after holding for a week, it continues to make you returns of 20%. So that's more than the underlying. That's 5 times more than the underlying that you can get. So still a good result. Now we continue to increase the number of weeks to know our maximum holding period of this, because if somehow Tencent, for some strange reason, is not moving up 4% in a day or in a week or 2 weeks, we want to know what's the maximum holding period we can hold on to this warrant for, okay? These two warrants. So you increase it to 3 weeks, 4 weeks. By the 4th week, you notice that the first warrant here would have gained only 4%, similar to the gains on Tencent shares. This means if you are looking at this warrant or you have bought this warrant, 5C6W, the maximum time you should hold on to this and get out of this warrant is 4 weeks. Okay, do not hold it beyond 4 weeks. Because I think the retail mindset is this. Our target level was 405. The index or the stock has gone there. But what do we like to do? We get greedy, right? We think, let's hold on for a bit longer because still making 20% gains, right? Very good. So I continue to hold on, and I'll wait and wait. And just so you know, in this case, the warrant will only allow you to wait for 4 weeks, okay? So if the market had already gone to your target exit level, know that the most you have is 4 weeks to get out, okay? And you will see then, if you continue to increase the holding period of this warrant in the first warrant here will now make you losses, even if your view was right. So this is why short-term trading instruments, you need to always assess and make a decision on your maximum holding period so that you don't end up losing money. But what if you had selected the second warrant here instead? NVLW, it's got a longer expiry date. Now by the 5th week, it will continue to make you magnified gains relative to Tencent. It will make you 12% relative to the 4%, 3 times more. And you can continue to increase this to the point where, again, by the 8th week, it's still making a gain, but it's no longer giving you the gearing that you're looking for, right? It's less than what Tencent shares have direct shares have done. So know that with the second warrant, the maximum holding period is actually 7 weeks. Okay, this is how you use a tool like the warrant selector that was invented to help you answer the question on your maximum holding period. Now let's go back to step 3. Oops. Okay, let's go back to step 3. How do we know how long, step 2 was how do we know what's our maximum holding period? The other thing I wanted to point out is some people like to hold things until expiry. Even though I tell you how you all bought the selector tool, tell you the maximum holding period is 4 weeks, right? But some people just like to hold it until expiry because they have the mindset, just like shares, whereby, I will buy it and hold on to it, forever. But with warrants, you can't do that because 1, they have expiry date. But 2, they stop trading before the expiry date. Why is that? The reason that is done is because some people accidentally short warrants or shares, right? And we need to provide for the buy-in. Okay, that's really the simple reason, and that's a standardized rule. So it's not that we made it up to trap you. You know, some people say, hey, you know, how come you don't trade all the way to expiry date? That's because we need to provide for those people who accidentally short the instrument. Now, with Hong Kong stock warrants or index warrants, you just have to note that the last trading date is the 4th business day before expiry, provided that the Hong Kong market is open. Now, I'm telling you about warrants traded in Sing dollars, but the Hong Kong index and the Hong Kong stocks are traded in what? Hong Kong dollars, and they are listed in Hong Kong, right? So they follow the Hong Kong holiday. Now, if the last trading day, which is the 5th day, 1, 2, 3, 4, 5. Now, on this day, if Hong Kong was shut, of course, it's not going to be shut because of typhoon anymore, but if Hong Kong was shut for their holiday, their Dragon Boat holiday, by the way, was, you know, they have a Dragon Boat holiday. We don't, right? We just eat dumpling, right, at home without holiday. But when they have a holiday, they're shut. We are not quoting, so you can't get out. So there's something to note, okay? And fear not, on our warrant search page, we actually have the last trading date stated there. So if you're one of those, you know, you didn't mean to hold it to expiry because Jamie told you not to get out to use the selected tool, but you've been getting it wrong and you refuse to cut your losses and you wanted to hold the warrant all the way to expiry, just note that this is your last day, your last chance to get out of the warrant, okay? And I'm telling you about expiry date, but my fear is that you guys then go back and look at the last trading date and think that's the last day you can get out of. No, the last day you can get out of is whatever the selector tool tells you that your maximum holding period is. Okay? And I'm just conscious we don't have a lot of time. So I also want to tell you about step 3, which is assessing effective gearing. As you can see, warrants grow in different ways. Some warrants grow 5 times more than underlying. Some warrants grow 20 times more than underlying. So how do you know and how can you expect how much the warrant will grow? The answer lies in the effective gearing level. Again, something that's stated on our website. Okay, you can easily look for it. Oh, it's not shown here. Okay, but the effective gearing level in this case of this warrant, okay, 10 times, is stated on our website. Now, using the warrant selector tool, if you have finalized at this warrant, this gearing also tells you what? It also tells you your investment amount. It helps you to estimate because, like I said, you know, warrants are a fraction of the share price, right? So you get a magnified exposure to the underlying. But how much should you invest? The answer lies in the effective gearing level. In this case, this is a Hang Seng put warrant. You know, you're a bit worried because now it's gone to 19,000. You're not sure if it's going to pull back because everyone says there's a resistance level, right? So you are conscious and you've already gone long. You bought the ETF, you bought futures. And you're worried, okay, or you've bought 10 cent shares, you're worried about the pullback. You then can consider a Hang Seng put warrant, in this case 10 times. How much should you buy? You know, how much should you put into this warrant? If you were holding a portfolio of, say, $100,000 worth of 10 cent shares, in this case, and $100,000 worth of a Hang Seng ETF, you know, that mimics and tracks the Hang Seng, and you're worried about the short-term pullback, if you piled in $100,000 in this. Now, using this put warrant, you can use the $100,000, divide by the effective gearing level of about 10.4 times, and you arrive at the little investment that you need to place into this warrant to hedge against the downside. In this case, you put in about 9,600 and divide it by the cost of the warrant. In this case, the warrant will cost you about 7.3 cents. You can see it, you know, at warrants.com.sg. Okay, and you need only to buy approximately 132,000 units of this warrant. And this is how you decide from, you know, the amount that you're investing down to the number of units of warrants that you should be buying. Now, this will help you to hedge against $100,000 worth of a portfolio. Why? Because when the portfolio moves up 1%, this warrant is going to move 10 times, 10.4 times more. Therefore, you do not invest the full $100,000. Okay, because if you invest the full $100,000, now you're not hedging, you know. You are now betting on the downside so that you gain much more. You gain 10 times more than what you would have lost in this investment. Okay, so just be careful to not invest the full amount to hedge your portfolio, but rather a fraction of it. Okay, depending on the effective gearing level. So that's step 3, using effective gearing to select your warrant and know how much to invest. Step 4, warrant spreads. Okay, always buy a warrant on tight spreads. How do you know whether a warrant's on tight spreads? Again, we invent tools to help you to understand warrants better. We've got this tool called the Live Matrix, and we're probably the only product issuer that shows you live where the product is trading. You go into warrants.com.sg, And the live matrix is on the home page. You need only to click into it or into whichever warrant you're interested in looking at, which, once you've filtered down to the warrant that you're wanting to look at via the selector tool. Okay, and you click into it and you will see that this warrant, okay, you will see live how this warrant moves alongside the underlying. So, you get a better understanding of that. But more importantly, you get to see if they're on tight spreads. Now, what is the minimum bid and offer spread for securities listed below 20 cents in Singapore? Anyone? So in this case, what's the minimum spread for something that's 8.1 cents in price? Anyone? What's the bid and offer spread for DBS? Here, nobody trades local shares, are all only looking at China, is it? DBS is 1 cent, right? Now, for securities below 20 cents is actually 0.001. Therefore, the minimum spread is, if this was 7.9 cents, the next spread is actually 0.001 more than that, it's 8 cents, okay? So is this warrant on a tight spread? Yes, okay? And if a warrant was, say, 7.9 cents on the bid and 9 cents on the offer, is it on tight spreads? No. Okay, just note that, okay? And so you always want to pick a warrant on tight spreads. Why? Some of you are saying, why? Very simply, because as an investor, whatever you buy on an offer, you want to be able to throw it back as cheap as you can, right? And the cheapest is the minimum bid and offer spread. Okay? So just note that all warrants typically have got a minimum bid and offer spread of 0.001. And you'll be able to observe that on the live matrix. Now, finally, how do we quickly find out the number of, the number of warrants and the type of warrants available? Go to warrants.com.sg. We've got a warrant search page where it tells you all the underlines that we have. And more importantly, Singaporeans love shortcuts, so we've created a shortcut. We created this logo, known the FIRE logo, to mark out trending warrants. Trending warrants are effectively those warrants that are on the tightest spreads with the highest liquidity, bid and offer volumes. Okay, and we had that because, we figured you would like a shortcut way of choosing warrants. But again, I always suggest that you then use the warrant selector to estimate how the warrant price will move based on your target level in the short term, okay? So that you can brace yourself for what's coming, right? How much percentage gains or potentially losses if you got your view wrong, okay? And it's my duty to tell you of the warrant risks involved. Obviously, it's great when gearing works in your favor, when it grows by 600%. For those of you who made that kind of gains before in a warrant, congratulations. But of course, if you're wrong, if you have bought a put warrant in the examples that I provided, you stand to potentially lose all your investment capital. So that's the risk of a warrant. And that gearing works both ways. And finally, if I can repeat myself again and again, warrants are short-dated instruments. Now, if you want to trade a long-dated view, a view of 6 months or a year or 2 years, please go consider other instruments like the shares directly or ETF, etc. But if you were just keen to look at what the market would do in the next month, in the next week, in the next 3 months, then you probably want to consider warrants, hopefully for the reasons that I've stated, for the gearing, for the low amount of capital that is required, okay? Finally, I don't know if I have enough time for this question, but how do warrants compare to other leverage products is a question I get very frequently. And I basically listed some of these, including CFDs, including DLCs, futures itself, and buying stock on margin. It's a lot to digest, but I want to quickly point out that the feature of time decay and implied volatility, yes, it's something unique to warrants, but it manifests in different ways in other instruments. They're just not called that, okay? So there are other unique features of other instruments that you need to know. More importantly, your maximum loss. This is very important, right? Some of you who believe that other, investing directly in the futures is better. Why would I look at a warrant? Well, because you could lose more than what you placed up front. And that's very important. Similar to shares, if they become zero, that's it. And let's not say that doesn't happen, because we have seen companies go down. And whatever you have placed up storage, I can leave it for my grandchildren or whatever. Well, if the company shuts down, it's gone. You lose that full amount of capital that you placed up front. But the warrant, yes, it goes to zero, but it's limited to the small amount of money. So what I'm trying to say is you can lose 100%, but sometimes the 100% is less than the 10% you have lost directly by trading the futures or the shares, okay? So yeah, just so you know, you can sleep well at night with warrants because there is the maximum loss is capped, and you've got no margin call, so your broker's not going to ring you, late into the night or first thing in the morning to tell you to top up your margin. All right, costs and fees involved. Across products, you always have to pay your brokerage, you have to pay your trading fees, and that is the same with warrants. But because of the low cost of warrants, your fees and brokerage amount is probably the least amongst the products here. Okay, and finally, if you've got burning questions which I couldn't address today because I'm capped at 20 minutes. Now I do have a 1-minute video series. You can watch it on your way back home later or tomorrow on the way to work or just whenever you're free, to brush up on your knowledge a little bit more. We created less than 1-minute videos because we know these days you don't have the patience for anything more than a minute, right? So it's got different topics. If you need a refresher on anything I've said today, feel free to view these on our website. You can also scan the QR code here. It's big enough, hopefully, for you guys to scan, but you'll be taken to the Macquarie Facebook page, whereby the minute you share any of these videos on your Facebook, you get $8. This is not some scam. This is real, okay? So go watch the video, find out more about warrants, and then share it to win $8. Trade it, and then post about it, and you get $100. More details can be found on our website or on our Facebook page, okay? And for those of you who haven't subscribed, today we're giving away a free portable bag as well as an umbrella, okay? As long as you subscribe to our newsletter or sign up on our Telegram or Facebook pages. Okay, and with that, I'll come to the end. Thank you very much.
Thanks, Jamie. Let's start the fire chat. Can I invite Tim and Bruce onto the stage? If you do have questions, please leave your questions via Pigeonhole. They are to the left and to the right side. Just key in today's code. Thanks a lot, Bruce and team. So let me just do a brief introduction. Bruce is the head of fixed income at CSOP Asset Management, and Tim is the head of product investment advisory at CGS. And we are happy to have them here. So I'm just going to start the first question. I will help you ask some questions here, right? For Tim, have you had your dinner yet? That's a typical question. All right. As what I presented just now, I think that there's some interest in the Chinese market. Can you share your insights? What's driving this interest? And then do you think that now is a good time for investors to consider entering the Chinese market?
Yeah, well, we've seen the pullback, right, over the past sort of 18 months, 2 years, based on the policy sort of crackdown in China. But I think we've kind of seen the worst of that sort of feed through the economy. And now the valuations clearly in the China market are just too attractive to ignore. We kind of have to remember that China makes up about sort of 15% of the global economy. So it's a very sizable part of GDP growth globally. So that's not going to change. And so even though certain parts of the economy are slowing, we're seeing a consumer slowdown, we're seeing deflation, that doesn't mean there are not opportunities to capitalize on potential growth. And so, from the CGS perspective, we're quite interested. We've launched a CSI 1000 ETF, which is more focused on the small cap space in China. And for us, that's really where we see the exciting opportunities, because we're looking at a rewiring of global supply chains and onshoring. And so this whole onshoring concept is being talked about, friendshoring in relation to the West, in relation to the US, and relocating manufacturing to Vietnam, Mexico, etc. But that doesn't apply just to the West. That also applies to China. China really does want to onshore its production as well. If we think about stuff like chips, like even all these high-grade chips and high-tech chips, cutting-edge chips that NVIDIA, etc., is being banned from shipping to China. China still consumes about 30% of overall production of chips globally, right? So they need to produce their own. They don't want to be relying on importing it. And same thing with oil. That's why we've seen this massive push into clean energy, into solar, into wind, because at the moment they consume about 70% of the oil that they consume. They have to import that rather. 70% of the oil they consume, they import. So that's something that they think about from a national security level and also from a sort of a self-sufficiency level. And so in that respect, we're seeing really fast growth in a lot of these smaller, more innovative companies. They're operating in areas like materials, industrials, healthcare. And so this is an area that I think we're finding a lot more potential versus the old school state economy, state-owned behemoths that you'd find in banking or real estate or insurance. And so for us, yeah, the outlook is bright in the sort of small cap space, I would say. Like we're looking at around estimated earnings growth of around 25 to 30% for the CSI 1000 in 2024, which is very respectable. But you have to understand that this is much more of a growth-oriented story. This is much more looking at the longer-term growth trajectory of China and its sort of innovative smaller cap ecosystem.
Okay, so I think that team is quite bullish on the Chinese stock market. Then I'm seeing a question from what you asked, and I'm just going to ask this question to Bruce. So do you think that there's any sector that we should be looking at right now? And how should one be investing in this sector?
Okay, definitely. First of all, I can't imagine I can talk about China again here because of this negative image against China. But in fact, China still has some growth potential in certain sectors. If we have to mention a few sectors, I would highlight the energy sector as well as the technology sector, because even we have some macro headwinds, those sectors can still benefit from the current environment. And regarding the energy sector, here I specifically refer to those SOE and central SOEs, because first of all, they can get the direct support from the government. And second, because of these reduced capex, together with the favorable supply and demand dynamics on the back of the geopolitical tensions, together with some global supply chain disruptions, those energy firms are still cash rich and can transit these into a attractive dividend yield, let's say 5 to 6% levels. And one proxy for these high dividend or energy play on SGX is definitely the CSOP Huatai Prime Bridge, the SSE Dividend Index ETF. And year to date, it's already gained at around 12%, even in Sing dollar term, and the ticker is SHD. And in terms of the technology sector, again, I will start from the onshore tech names. I have to say, of course, everyone are concerned about this sanction risk, but not all the tech names are under the sanction or under the same level of the sanction as compared to the cheap producers, such as the new energy plays, or even the soft tech names, such as the platform economies in China. And even we'll talk about the hard tech names, which are still subject to the severe sanction. They at least can be mitigated from this domestic substitution story, which I already mentioned this 1.5 years ago, maybe the same place here, because the central government can urge the different levels of government entities to purchase the goods and services for those from those domestic producers, and also can encourage the private sectors to do a similar support. And these substitution can start from the middle to low end, and buy more time for those producers to concentrate their resources in terms of the to the next technology breakthrough. So the proxy for this one, of course, in addition to this CSI 1000, for CSOP, we also have this CSI Star and the Chinex 50 Index ETF. The ticker is SCY. And year to date, it's dropped roughly 4%. But based on their historical pattern, it seems it's already bottoming out since end of January this year. And also this morning, it also rebounded by 1.5%.
Okay, I think that one of the biggest concerns I have, right, I know that both of you are bullish and slightly to get a little bit bullish on the Chinese market, but one of the biggest concerns, as much as what I feel for Jamie, I also felt the same for myself. My portfolio has been going downhill since by investing into the Chinese market. So is there any like investment strategies that one should consider? Or how should, any asset class that you would recommend? Particularly, maybe we might want to focus into the ETFs and what ETFs, how we should buy these ETFs. Anyone?
Yeah, I mean, I think it depends on your risk appetite, really. I mean, I think for those looking at sort of the high dividend yielding, sort of stable SOEs, I know that there's been a swing in sentiment. Obviously, in the 2010s, the SOEs were hated by everybody. The ICBCs, the CCBs, the CNOOCs, no one wanted to touch them. Now they're back in vogue, right? Everyone loves their 8-9% dividends. They're not getting smashed by President Xi and his policies. But how long will that last, right? I mean, they're still capitally not very efficient. I'm not sure entirely whether those dividends are sustainable, and everyone's always a bit concerned about the Chinese banking sector just generally, right? So I think that's an area that you need to really watch out for. But if you do want to get into those ETFs, I mean, there are plenty of options in terms of large cap China, which you can go into. I think for ourselves, I mean, as I said, small cap is just a more interesting space because of the move towards leaving Hong Kong behind, right? There really the desire to sort of nurture Shanghai and Shenzhen as listing centers, and we've kind of seen that with, the stock market and whatever over the past sort of decade, the evolution of the capital markets in China. And the through train in Hong Kong, the Stock Connects, that's really linking everyone up. And we've kind of seen that with some of the recent reforms where I think the dividend tax is going to be waived for Hong Kong investors on the Stock Connect, right, for certain A shares. So I think there's always a lot more interest in the growth potential in China, which is really underappreciated at this point. So I think from the CGS perspective, we're looking at really just the more sort of healthcare, farmers, like IT, as Bruce mentioned, just more growth-oriented type sectors that have the potential to benefit from government policy. And also have the policy support that is helping them grow earnings, which is really key. I think one of the key things that we don't really look at is earnings growth. At the end of the day, powers valuations and then also price, right? And so in the small cap space, we're seeing really strong earnings growth. So for us, that's an area that we're keen on.
Okay, so that's small cap. By the way, you guys know about ETF, exchange traded funds? Okay. All right. Maybe I just want to ask this question as well to Bruce, right? So you have like a portfolio of ETFs in CSWAP. Any particular one that you would like to share here with the audiences?
I already mentioned a few names, but I think the good part for ETFs is that, for example, for onshore equities, if you directly buy them, it's still very tough for individual investors. Even you have a lot of money, it's still hard for you to directly to apply a QFII quota. But ETF can be quite different because you can use the SGX listed ETF to access these onshore assets. In addition to the high dividend stock, which are more on the defensive side, and we also have the growth oriented. The so-called double 50 ETF, but also even we look beyond the equity asset class, we still have the China bond ETF. Ironically, although the image against China, even against renminbi, is not that positive, but China's government bond is actually the best performing government bond markets year to date. Yeah. Even in US dollar term, they still gained because elsewhere it's high for longer. Only China PBOC still have some easing bias. But in the meantime, they also have an intention to defend the RMB to keep a relatively stable capital market. So in this case, in Singapore or on SGX, we have some choices for the onshore equities, not only our issuers, but also our peers. But for fixed income, the investors still have some choices.
Yeah, but I think that while we are bullish, or rather semi-little starting to be a little bit more bullish into the Chinese market, but are there any factors that we should be looking out for, whether they are political factors or economic factors that we should be concerned? Basically, I'm asking about the risk point of view. Anyone?
Yeah, I mean, I think from the policy perspective, the deflation is is really weighing on the market. You've kind of seen that with falling prices at the factory gate and then also for the consumer. So what the market is really waiting for, I think, is a turning point or some sort of massive fiscal bazooka, which they're hoping the PBOC will deliver in a similar vein to the Fed doing it in the COVID, when COVID came on, and then also in the financial crisis, cutting rates and I think he's invited a couple of a bit more liberal economists to brief him recently. So that's a positive sign, I think, for investors to see whether he's open to the idea of actually maybe turning on the fiscal taps, because I think that's what's going to be required for China to try and escape this deflationary trap. And so I think most of the market is really waiting for something big to be announced.
When? I think when is
Yeah,
the
right?
key question, right?
that's the key.
I'm interested to know when. How about Bruce? What's your opinion on this?
yeah.
Any reasons to look out for?
Yeah, maybe there's a timing for July, the plenary session.
July.
yeah.
July.
I can't talk about too many sensitive topics, but if you look at year-to-date developments of the political trend, the March, the twin sessions, they at least set a tone for this year, which is they will at least stabilize the growth. And the upcoming plenary session, which was delayed, actually this is supposed to happen late last year. So investors still have some expectation to see whether China will continue to support growth in a more powerful way. And I think that's the full stop for the political part. And for economic indicators, I think PBOC is important. And also, I think the fiscal policy together with the property market and also the Fed move will be the three main indicators we can watch. For example, for the fiscal policy, at the beginning of this year, investors used to have a very high expectation of the fiscal expansion because in China, the household leverage and the corporate leverage were very high. But the central government leverage is still at a reasonable level, which means they still have some hopes to increase the central government leverage. But the fiscal deficit, when it said it will remain at 3%, it did disappoint a lot of investors. And that's also explained part of the reason why the equity market was volatile at the beginning of the year. But on a positive note, the fiscal policy can be flexible. And following this special government bond issuance, it's worth to check whether there will be more to follow for the rest of the year. And I think that's for the fiscal part. And for property market, I think in April and May, there are more supportive measures, such as the relaxation of the purchase or even the lower mortgage rates. I think that was encouraging. And during the initial stage, there are some rebound and also some flows are coming back. But investors need to have more clues on the consecutive months of the improvements in terms of the sales, or at least the smaller declines of the property sales in China. So that's very important. And finally, it's about the Fed move, because the Fed potential direction will impact the timing of the PBOC's more broad-based easing bias, because they also have an intention to defend the renminbi. But the good news is that following the last week's FOMC meeting, of course, there may not be any immediate cut, but there's also there may also not be any further hike. I think that's good enough.
Okay. All right. So I think that Bruce also answered one of the questions that you guys asked, right? You asked about the views on the Chinese real estate sector. From here, right, what I am encouraging, if you do have any other burning questions, you can use the pigeonhole and key in the code, right, 19 June 24, right, and ask questions to Bruce and team. I believe that team has some slides to show.
Oh yeah.
Yeah.
So I mean, I think
while we're waiting for the questions, yeah.
Yeah, for investors who are interested in the CSI 1000, we have it listed here on the SGX. It was listed last November, so it's available in both Singapore dollar and US. Yeah, full goal CSI 1000 ETF. And is accessed via the Stock Connect in Hong Kong. So there's enough liquidity there to buy into it long term. And I would say it's a very diversified mix of companies. It's much more focused on material tech versus sort of the old state industries like banking, finance, insurance, etc. And it's well diversified with around sort of only 5% of the top 10 holdings. The top 10 holdings rather make up only around 5% of the overall portfolio. Whereas if you're looking at the CSI 300, the larger cap, it makes up around sort of 25-30% of the overall portfolio. So it's a lot more concentrated in the large cap. Whereas with the small cap, you've got a lot more broad exposure to the economy.
Okay, I think that CGS also has a booth outside. Just they set the booth outside. You can just go and talk to the people at the booth. But let's come to the Q&A. Continue to send your questions. We do have a questions for Jamie as well. But let me just ask my burning question. Okay, my burning question was that I was in Changsha and Shanghai last year, December. And I spent my Friday and Saturday doing only one thing. I went to almost all the EV showroom. Two things. First, I was able to sit on the car, not drive, okay, but sit on the car, on every car that I can try on, and they were fantastic. You don't need to press the button, the car door automatically opens. Okay. The fact that I was able to try on every single car means what? Means that there's no one in the showroom. Second, I told them I'm from Singapore and it's happy because they have someone finally to talk to. All right. So coming to my question, all right, to the question here, right? So what do you think of the EV industry, EV manufacturer? Right. And then should we avoid Chinese EV to anyone?
We should embrace for it. I was in China end of May, just 2-3 weeks ago.
Yeah.
Yeah, if you look at the plates, the car plates there, maybe already nearly 50% of the cars already EV instead of the oil cars. And why should we avoid it? I saw this question, overcapacity debate. But if the Chinese manufacturers can have the capacity to produce the EV with efficiency, with cheap cost, why we label this as overcapacity? It means efficiency. It means a more competitive, let's say, the models and more competitive EV batteries. And this part is the Western countries, the Western economies, they have no angle to do sanction from the technology perspective because the chips used in the EV models, it doesn't have a very high requirements, which means even the Chinese domestic producers can produce such chips. So that's why they can do from another angle, let's say the dump off for those products. Okay. But based on our observation, the acceptance of the Chinese EV within China is very, very high, particularly for those young generations. It's no longer to pursue the oil car like produced by Germany or by Japan. And even in Southeast Asia region, you can see the penetration. Now a lot of BYD model in Singapore and in Malaysia and Thailand, when I was there for the business trip, a lot of consumers, they will directly buy the private cars, EV produced by China. Or even in Japan, there is an advertisement for BYD.
Yeah. I have to agree on this because I have second part of the story that I've not shared. So I went to Huawei because they also have the EV. I went to BYD. It was a huge contrast to the small EVs brands. Okay, I think that there are certain EV brands that still are quite getting a lot of interest in the Chinese market. Especially we saw that Xiaomi stock price went up very well after the announcement of their EV and also the overbooking of their new model. Okay, but anyway, that's really my view. But what do you think, Tim?
So I mean, I think for me, this is much more of a question, maybe not on overcapacity, but on price. I mean, we've price cuts in the EV industry in China, right? It's been a fierce price war. Tesla's got caught up in it and they've been cutting prices. If I was a Xiaomi shareholder, I'm not sure I'd want to see them reproducing cars because, to be honest, like the environment in China is just so competitive. If you think about consumer goods or anything of that nature, China is just fiercely competitive. And if you go into EVs, that's just that's the peak of competitiveness, I think. And so margins over time are going to bound to be eroded, I would assume. And so if you are going to be an EV manufacturers, you want to really be in the leader because even about a year or 2 years ago, we had about 80 to 100 EV brands. So there was just way too many brands. And so they all looked the same. There was really no differentiating factor with a lot of them in terms of the aesthetic or tech. But now some like NEO and sort of XPeng, I think they're trying to move towards differentiating themselves with charging infrastructure and software, which is fine. It's done a decent job, I'd say. But there's nothing really in the same league as BYD. I think BYD is probably the leader. It's just got such a massive presence in terms of its battery tech as well as its actual hardware. So it's got a lot more, I think, of a moat, I'd say, versus all the other EV brands, right? Because even Tesla is starting to struggle in terms of price cuts and the price wars in China. So if you do want to be in it, I mean, I personally would think that BYD would be the one that would be the safest. If you've kind of seen the share prices this year, BYD is also the one that's held up the best, right? And it's just got scale. It's just humongous. And it's beaten out, as Bruce was saying, on tech, it's beaten out the likes of Panasonic in Japan for battery tech, right? They've just done a very good job and they've executed very, very well. So I think on a global scale, they're also starting to see a lot more exports to European countries, to Southeast Asia. And China actually became the biggest exporter of cars, I think, or has become the biggest exporter of cars this year, is expected to overtake Japan as the largest exporter. So a lot of people don't realize that. They just think it's the Chinese EV market, but actually China's exporting a lot. Obviously not to the US because of sanctions and tariffs, but to Europe, to Southeast Asia, to other countries, they'll continue to do that. But I would be a bit wary of the sort of second tier names in the EV sector.
So if you do not know, BYD recently announced that they have this new battery one charge, 2,000 kilometers. We just drive from Singapore to Thailand. Yeah, that's really, really impressive. All right, I think that I have one question here, which is on the China macro data. I just want to modify this question a little bit. More into, is there any China macro data that we should see in the future that would really, really boost the Chinese market? Rather than to say it's depressing, but do we have any data that we should be looking at? Any specific things that we should be observing or investors should be observing that we should see a huge boost to the Chinese stock market?
So personally for me, it'd probably be like exiting deflation at the factory gate, producer prices turning positive.
Yeah, or maybe a huge stimulus.
Prices. Yeah, stimulus.
Stimulus?
All the usual suspects, I would say.
Yeah.
I totally agree. And again, property. We can't expect property can be the driver like what they did 10 years ago, but it definitely can't be a drag. We need some improvements in property, as it accounts for 30–40% of the China's GDP growth, both upstream and downstream. So that's very important. But for now, I don't think it's much below consensus, because at the beginning of the year, the consensus is even higher. But now I think investors already are more rationalized. And this year also has some tactical inflow, even for equity market. The first time it happened when after the national team kicked in after the January this year, and second round is after the announcement of the property supportive measures. Then we see some tactical inflows, but we need some more strategic inflows or more sustained recovery for China macro economy. That's very important.
So inflow of money, I hope so. Yeah, stimulus. All right. If you do have any questions, I think that Tim and Bruce will be still around, but I'm just going to end this session with one last question for Jamie. In fact, the question is that how do public holiday in one market affects the warrants, especially when it's a trading day for the other market? For example, we recently had Hari Raya and Dragon Boat. I think that,
Over there? Was it from you? No? Now, thanks for listening and spotting that. So I mentioned that before. How is it that you have to look out for Hong Kong holidays if you're keen on trading whether the Hang Seng Tech or Hong Kong stock warrant? And the answer is Macquarie is the market maker providing the bid and offer quotes. And how do we provide quotes? We track the underlying, right? That was one of the first slides that I showed you. Warrants track the underlying. Depending on whether it's call put, then they move differently, right? So if they track the underlying and the underlying market was shut, can I track the underlying? I can't provide quotes to you, even if the Singapore market is open. Okay, so that's the long and short of it. Does that answer your question?
All right, thanks a lot, Jamie. That's answered my question. Thanks a lot for joining us today, and thanks, Tim and Bruce. If you do have any questions for them, or if I have not taken your questions, then I think that we'll be around to take your questions. But that's all for today, and hope that you have gotten a lot more, and thanks a lot for spending time. You guys don't have a question for me? Okay, thank you. Good night.